Hi there, and welcome back to Energy Flux on Air. I'm your host, Seb Kennedy, founding editor of Energy Flux, the energy newsletter analysing European natural gas and global LNG markets through the lens of Europe's energy transition and global geopolitics. Well, it's been a totally wild week in the European natural gas market. The Dutch Tidal Transfer Facility, the TTF, the benchmark for European gas prices, has been on a real roller coaster. If you've been watching TTF, then you'll have seen just how wild it's been. The front month contract traded as high as almost 58 euros per megawatt hour on the 11th of February. It then crashed down by about 1/5 and settled at about 42 euros per megawatt hour on Wednesday this week, and then rebounded 7 or 8% on Thursday and on Friday. That's today, the day I'm recording. It's retained most of those gains and is trading at about 44 euros per megawatt hour. These are big moves. The gas market doesn't always move like this, or it never used to, although in recent times, increasingly, we are seeing big swings like this. And in today's episode, I wanted to start off by talking about why this is happening and what it all means for energy and gas in Europe. If you're a regular reader of Energy Flux, then you'll be aware that the natural gas market in Europe has become a highly speculative marketplace. It's a commodity that's really dominated by investment funds. That's speculative hedge funds, money that's managed on behalf of clients, which is used to take directional bets on the future price of natural gas in Europe. And these investment funds are managing enormous sums of money. The positions that the investment funds take are so big that they frankly move the market. You have funds managing hundreds of millions of euros worth of contracts, and they will take a bet in the market by taking a position on the future price. So they'll go long or they'll go short. They'll do that with the intention of profiting from future price moves. So if they go long, the price goes up, they cash out, they make money. Similarly, they can go short. And if the price goes down, then again, they make money. And every week we know how the funds are positioned because there's a report released from ICE, which is the exchange where the TTF contract is traded. And it tells us how many positions are held by how many funds and how many of them are long positions and how many of them are short. And you can net them off to find out the net position of the investment funds. I've been tracking the investment funds for several months now, and the movements of big capital on TTF gas futures, so the big money bets on EU gas prices, are just staggering. We've seen the investment funds hold a net long position of as much as 292 terawatt hours, which is just a spectacular amount of gas. It's orders of magnitude more than the whole of the continent of Europe consumes in a single year. And the size of those positions really influences the market. And we know this because we can plot the correlation between the movement of large amounts of capital in and out of these speculative positions and correlate that with movements in the price on TTF. I've done the statistical analysis in Energy Flux, and the correlation is consistently above 50%. Often, depending on the time frame over which you're measuring it, often it can be as high as 70 or even 80%. So although we can't establish the direction of causality between the fund movements and the price, it's very closely correlated. So I think we can assume that there is a big influence from the way that the capital moves and the way the price moves. Now, what happened last week, and we're talking about last week because there's a delay of several days between the close of the week and the Commitment of Traders report being released. The week ending on Friday last week, that report was published on Wednesday, and what we saw was a very strong sell-off in long positions. So over the last 2 weeks, the investment funds have reduced their net long position by about 60 terawatt hours. That's a major sell-off, and that was done by them closing out long positions. That sell-off coincided with those dramatic 25% downward price movements in TTF. It's very hard to identify any changes in the physical underlying supply of natural gas in Europe that would have justified a 25% sell-off in the price, which reinforces my view that the causality is almost exclusively flowing from the movement of big money into the price action rather than the other way around. I'm sure that some of the capital does move in response to prices, but it's hard to conclude that the majority of the price action that we're seeing is not driven by these hedge funds sloshing money in and out of long positions. So 60 terawatt hours were sold off in 2 weeks. Last week it was like 27.4 terawatt hours. This is a big sell-off. We don't normally see moves quite as big as this. And again, we don't see price movements always as big as this. So why did they do this? Well, on this occasion, it seems to have all been in relation to natural gas storage and the EU's regulation around gas storage facilities. The EU has refilling targets. Natural gas storage facilities across the whole of Europe on aggregate must be refilled to 90% by the 1st of November every year. And they have interim targets in the months leading up to November. So a certain amount must be reached by May, June, July, August, until you get to 90% across the EU. Now, there are some details around that. Some countries have what are called derogations, so they don't have to achieve 90%. But on the whole, the 90% must be achieved by the 1st of November. Now, there's been a very active discussion between EU member states, energy companies and trade bodies about whether these targets are really fit for purpose. And the reason people are doubting it is because although they do ensure energy security in time for winter, the gas is held in storage for the colder months. The problem is that it communicates to the market that the gas storage operators are going to be refilling their gas stocks to certain levels at given intervals. So they have to buy a certain amount of gas at particular months throughout the summer refilling period. And what's happening with the big influx of these hedge funds is that they look at the storage targets and say, well, you have to buy this much gas by this date. It's very simple for me to take a long position over the summer refilling months and then hold that position because they know that the gas suppliers, the gas storage operators are going to have to buy that gas and take those contracts off their hands. And then they cash out and they make enormous profits and then they repatriate those profits back to their clients, which I'm led to believe are predominantly American or perhaps Asian hedge funds. We don't really know who they are, and that's another bone of contention around the way that the TTF operates, is that there's a major lack of transparency about who the market players are. Who are these big funds that are coming in and moving the market in this way? We just don't know. That data is not revealed in the Commitment of Traders report. So basically, the EU gas storage regulations are a bit of a speculator's charter, and there's a growing awareness that this is a problem because it is essentially fleecing consumers for the benefit of some hedge funds and investment funds and money managers. And that's obviously not in the best interests of European consumers and is not the best way to manage this critically important energy infrastructure asset. So what's happened? Well, the European Commission has decided to look into this. And they've drawn up something called an action plan for affordable energy. A draft version of that report was leaked to the press, and I'm going to read out a little section from the leaked version. And in relation to gas storage, it had lots of good ideas in there about how to make energy more affordable in Europe. And natural gas is just one element of that. But with regards to natural gas storage, it said better coordination among member states with the support of the Commission, and more flexibility can also help in refilling gas storage at better purchasing conditions during the refilling season. So that sparked a great deal of speculation about what does that really mean? What do they mean by flexibility? And because there are lots of member states, particularly Germany, saying that the 90% by the 1st of November refilling target should be relaxed or even withdrawn, and there were similar noises made by energy trading bodies and all sorts, then there was a real expectation that this meant they were going to get rid of the target or relax it or review it or whatever. What happened? Well, that didn't really happen, but the action plan was finally published and the wording changed a bit. So this is the final wording, and it said, and I quote, better coordination among member states, and more flexible filling trajectories with the support of the Commission can help to reduce system stress and avoid market distortions linked to gas storage refilling, supporting refilling at better purchasing conditions and security of supply. Now that triggered a fresh wave of newspaper coverage and headlines talking about there were going to be new gas storage targets. And what did the investment funds do? Well, they looked at that and they said, well, if they're going to be new gas storage targets and they're going to be more flexible and possibly much softer and not as aggressive on the refilling over the summer, then our long positions, because we've taken massive bets on long TTF positions over the summer refilling period, those bets, the only rationale for making those bets was the regulation itself. So I think that a lot of the traders, and I'd imagine that these are algorithmically AI-enhanced traders which are executing really based on the headlines alone. They read those headlines and said, well, we need to sell. And so they hit the big red sell button and they offloaded 60 terawatt hours of natural gas net length and essentially crashed the market for gas. And what's quite amusing is that all these trades, these, multi-million euro trades were all executed on the basis of headlines that were at best misleading, because if you pay attention to the actual final version, which I just read from, it talks about more flexible filling trajectories. It doesn't talk about more flexible targets themselves. So the end destination of the 1st of November, 90%, that's not in play. That's not going to be reviewed. That's probably going to stay in place. They're talking about the trajectory, so the interim targets for the months between May, when refilling starts, or from April until November. So the pathway towards 90% by the 1st of November, that could become more flexible. But the end destination of 90% is almost likely still going to stand. And so we saw a big sell-off based on that misunderstanding. And it was only a day or two after the action plan itself was published that it seems traders actually read the report and digested what it actually meant. And so when they woke up on Thursday, they realized the error of their ways. There was a massive rebound because I think they would have bought back a lot of these positions, and the price went shooting up by another 7, 8, 9%. And that's what happened on Thursday and Friday this week. So we won't know the actual movement of big capital this week until next week because of the delay I talked about. We have to wait until Wednesday next week to find out what happened to the investment fund positions this week. But my bet is it's going to be a bit of a mess because it's all aggregated across a single week. We don't know what funds did on Monday, what they did on Tuesday. All we know is that in the week ending the 28th of February, then they did this. And so because we've seen a kind of V shape in the price movement, then we're probably going to see a lot of long positions sold off and then bought back again. So it'll be an interesting one. I don't think I'll have a clear direction, although I might be wrong. You never know, because the price has gone down and up again. We'll just have to wait and see. But the whole experience really just reinforces this view that the big capital is moving the market. It's moving it on, spurious, partial information. It's kind of trade now, ask questions later. And that's really what's driving the volatility on the TTF at the moment. We don't get this kind of considered, thoughtful execution of trades based on all of the available data. There seems to be a real premium attached to this idea of getting ahead of the market, to trade ahead of the facts and to take positions that are then more valuable by dint of being, an hour or two early, rather than waiting to get the full picture and essentially being late and missing the boat and missing the trade. That's how it seems from the outside, from my vantage point. We're still waiting for the EU to publish more details about how it intends to increase the flexibility around the gas storage interim filling targets. So we'll have to wait and see. But my impression is that the targets for 1st of November will remain, and that we're going to see the investment funds double down on their summer storage squeeze by taking those long positions and then cashing out and making a profit. Anyway, the upshot is that the Dutch TTF price is still much lower than it was just a couple of weeks ago. And that's fundamentally changed the outlook for liquefied natural gas trade, because the price of LNG on the water is very much a function of what's happening in Europe. Because since Europe lost Russian gas and turned to LNG to fill the gap, then the price of TTF has been influencing the price of LNG on the water a great deal. And what does that mean? Well, if TTF is higher than in Asia, then any spot cargoes, spare cargoes, they can be traded into Europe and they can profit on the greater differential. Or if the price in Europe goes down, then shipping to Asia becomes more profitable, and cargoes head east. So what's happened? Well, the net back on that's the profit on a cargo leaving the US Gulf Coast heading into Europe. That's now less than it was, and comparatively, shipping it to Asia has become comparatively more profitable. That's what's called the interbasin spread, and the arbitrage opportunity for shipping US LNG to Asia is now improving. What does that mean? Well, it means that if Asian demand increases, and it's been quite low recently, but if it increases, then you're going to see more competition for cargoes essentially between Europe and Asia. Europe, if it wants to attract LNG cargoes to refill its storage facilities over the summer, is going to have to compete with Asia. Now, there's a lot of uncertainty around what Asian demand will do. There are very credible arguments on both sides to say, well, it could be a very heated summer of a tug of war for LNG cargoes between Europe and Asia. But at the same time, there are reasons to think it might not be. You know, if there's a massive heat wave across parts of China and Japan and South Korea, and they're buying loads of LNG to produce electricity to run their air conditioning units, then yeah, you can expect to see the LNG price reflect that competition. But at the same time, wind and solar are going absolutely gangbusters in Europe. By the time the summer arrives, I expect to see long periods of very low or even negative pricing in the power market, because the market is just completely swamped by wind and particularly solar power. I expect new records to be set for renewable power generation. That squeezes gas out of the power mix in Europe. And of course, it's warm in the summer, so we don't need much gas for heating. And on the industrial side, so the industrial sector that uses gas, it's still really limping along in Europe. It hasn't recovered. There is really no notable economic growth happening across most of Europe. And gas demand is kind of essentially flatlining in that space for that reason. So everything depends on demand, as usual. Now, moving on to reader questions. Not had so many questions come in this week. The mailbag is not quite so full. So a quick reminder, if you want to ask a question or just have a comment and want to have it read out on the podcast, then send me a message through the Substack app. Just go onto Substack and search for Energy Flux or search for me and send me a message and I'll check it out. I also start subscriber threads every Friday in which readers ask their questions. I do prioritize questions from paid subscribers, but I read everything. And if it's a quiet week, as it has been this week, then yours might be read out even if you're not a paid subscriber. So let's have a look at the first one. This question comes from Apurav in India. He says, does Henry Hub, that's the benchmark gas trading hub for North America, does Henry Hub and TTF price have any correlation between them? And if so, how should we interpret it? Well, this is a great question and something I've been meaning to look into in more depth in Energy Flux. So the correlation between Henry Hub and TTF is definitely present. There is a measurable correlation, and particularly since 2016, since the United States started exporting liquefied natural gas to global markets, particularly Europe. And as LNG exports have grown, then the correlation has grown with it, because that creates this kind of economic linkage between North America and Europe that didn't exist before. So when the spread between TTF and Henry Hub widens, then US exporters tend to divert cargoes to Europe, and that kind of creates the price linkage. And we've seen, when there are events like the Russia-Ukraine invasion of 2022, then that massively heightened Europe's reliance on US LNG, which strengthened the correlation further. My understanding is that the causality is bidirectional, but it's asymmetric. And what do I mean by that? Well, let's imagine there's a domestic shock in the US gas markets, say a hurricane or output from shale fields changes significantly, then you can see the Henry Hub price increase, and that will erode the competitiveness of US LNG in Europe. So obviously the amount of profit that you get from a US LNG cargo is a function of the end price minus the cost of production, liquefaction and transport and regasification at the other end. So if your input gas, your feed gas, becomes more expensive, then your profit reduces. So that will, in a sense, affect what the profit is on the cargo, and therefore also can impact the price on TTF. But that's not the major direction of causality. It tends to move in the other direction. So TTF, the price in Europe, affects the price on Henry Hub. So surges in European demand, like during the Ukrainian invasion, they pulled more US LNG out of the Atlantic Basin into European regasification terminals, and that's like increases the draw on feed gas in and around the US Gulf Coast into those liquefaction plants, and that depletes or tightens the supply in the US domestic gas market, and that makes the Henry Hub price go up. And we did see Henry Hub spike as high as sort of $10 or even $12 per MMBTU. That's sort of 3 or 4 times the current price. We saw that occur during 2022, and that was directly a result of like this kind of massive structural increase in demand for US LNG in Europe because TTF price spiked, and it pulled Henry Hub with it. And that linkage is only going to increase as we see more LNG plants come online along the US Gulf Coast. Then we're going to see more gas drawn out of the North American market, and LNG, to the extent that it draws existing gas out of the market rather than being supplied by new production, dedicated production for those plants, then you're going to see those LNG plants essentially competing for molecules of gas with existing demand centres such as homes and businesses and factories across the lower 48 states of the United States. And this has the potential to become a political problem. I've written lots in Energy Flux about this, about the kind of the conflict at the heart of President Trump's policy to maximize LNG exports while also putting America first. Because if Americans are essentially paying more for their gas, which also means more for their electricity, then they might start to ask why. And if all those price increases are essentially a function of sending our precious natural gas freedom molecules overseas to these faraway allies who we no longer care about, then there might be a bit of a backlash. The MAGA movement might have something to say about US LNG. They might rise up and say, well, why are we sending all of our gas overseas and paying more when supposedly they're not a priority for us anymore because it's supposed to be America first. So that's what I mean about the bi-directional asymmetry. And there's also a kind of temporal angle to it as well, because if you think that the TTF price spikes, then they feed through very quickly into Henry Hub price movements. And that's moving in one direction and it's very rapid. But over the longer term, this kind of structural influence of Henry Hub pricing in the wider LNG market and therefore onto the European market. So as more export capacity comes online and there's more LNG that's essentially traded on a cost basis to Henry Hub, then the price of Henry Hub becomes very important to gas traders and gas consumers in Europe. And so you're going to have to see more gas traders hedging their exposure to Henry Hub price movements in order to manage their portfolios and manage their risk in the European market. And that's a trend I expect that will only increase. But thanks for the question, Aparab. That was a good prod to me to look further into this. It's something I've been meaning to look into and write a deeper analytical piece on in Energy Flux. The correlation between Henry Hub and TTF. I think there's some interesting statistical analysis waiting to be done in that space. And if you sign up for email updates from Energy Flux, then you'll be the first to receive them when they're published. Head on over to www.energyflux.news, sign up for email updates, and check out the archive. There's lots of material in there covering all of the topics that I've been talking about today, and I'm putting out 1 or 2 new pieces every week. Lots of data viz, lots of graphs. If you're into kind of data and analytical coverage of European and global LNG markets, then Energy Flux is what you need to be reading. So thanks again, and don't forget to send in your questions for the next edition of the podcast, and I will see you in about a week's time. Thanks for listening. Bye-bye.